Already, this is lecture 1 for week 3. We are still in topic 1. This is the second part of topic 1. Okay, so in this lecture, you will see I think 3 more subtopics related to topic 1. Okay, these are the subtopics to be covered in this lecture. The first one is you will see the components of financial statement, and then the elements in the financial statement, and then number 3 is principles and assumptions in the preparation of financial statement. Okay, let's see the components of financial statement. Okay, first thing, remember I have told you from topic 1 to topic 5, we are focusing on financial accounting. Financial accounting is a branch of accounting that can be used to record business transaction and to calculate profit or loss for a business. So now, financial accounting, the output of financial accounting is the financial statement. Financial statement is like a book. So the thing is like this: if you have a business and then you do the recording process every day, you record all the transaction. At the end of the year, you stop and you produce something from the record. The thing that you produce or output of the record is the financial statement. So financial statement is like a book. It is like a book. And in the financial statement, there are 5 components. Okay, see here. Financial accounting report or output called financial statements provide summarized information to the owner of the business. The person who do the accounting record is the accountant. So accountant prepare do the accounting record and then produce the financial statement. The owner of the business can see the financial statement and can read the information in the financial statement. So financial statement contains 5 main components. The first one is balance sheet, the second one is income statement, number 3 is statement of equity, number 4 cash flow statement, number 5 notes to the account. Okay, let's see the component one by one. So remember, the focus is on the accounting record for sole proprietorship service business. In this course, you learn how to do accounting record and prepare financial statement for sole proprietorship service business. Okay, see, the first component that we will see is the income statement. Income statement is a summary of revenue and expenses for a specific period of time, such as a month or a year. And remember, income statement shows the performance of a business. Income statement shows the calculation of a business profit. In accounting, if a business makes profit, we say that the performance of the business is good. But if a business is making loss, then we say that the performance of the business is bad. So always remember, income statement shows the performance of a business. Okay, this is the basic format for the income statement. Very simple. In accounting, like I said earlier, income statement shows the calculation of profit. So in accounting, the basic calculation to calculate profit, the basic formula to calculate profit is revenue minus expenses. See here, this is a sample business. The name of the business is Net Solution. So This is a service business, so this is the income statement. See here, the first item in the income statement is fees earned. Fees earned is the revenue of the business. So if you have to prepare an income statement, then you have to follow this format. So you have to write the name of the business, and then the period the income statement covered. So, and then you show in the income statement, the first thing is to show the revenue. So in this example, the revenue is fees earned 7,500 for the month of November in year 2007. So, and then after you show the revenue, you have to minus all the expenses. In this example, there are 1, 2, 3, 4, 5 expenses: wages expense, rent expense, supplies expense, utilities expense, miscellaneous expense. So total expenses is equal to $4,450. You have to add all the expenses, and then you will get the total expenses. So see here in the third column, revenue 7,500 minus total expenses 4,450. So the business get profit $3,050. In some textbook, the term net income is used for profit. Net income is profit. Revenue is something something that is coming from the providing of services. A business provides service, then the business will get revenue, and then minus expenses, then the business will get the profit. So this is the basic format for income statement for a service business. So in the future, if you have to prepare an income statement, you have to follow this basic format. So and then I have a second example of income statement. So see here, this is also an income statement. So see here, the name of the sample business is Fast Forward, and then the income statement. Then the income statement is for the month of December 2019. So see here, the basic format is same: revenue minus expenses. But in this example, the business is a consulting business, so the business has consulting revenue. See here, consulting revenue. In this example, the consulting revenue for the month of December is 5,800. But for this business, the business also has additional income, additional revenue. In this example, the additional revenue is rental revenue, $300. So total revenue is $6,100. Maybe this business it has a big building. So the business has a big building, and the business use the building to do the business, to do the consulting business. At the same time, the business maybe has empty space. So when the business has an empty space, the business rent the empty space. When the business rent the empty space, the business get $300 rental revenue. So the $5,800 is revenue coming from the consulting service. But the rental income, the rental revenue is additional revenue. It is not from the main operation of the business. The main operation or activity of the business is providing consultation. So rental revenue is the additional income. Maybe in the future, if you have a business, something like that, you have a shop, a big shop, and then you do the business. At the same time, you can rent some a space to others. That rental from rental revenue from the rental activity has to be reported in the income statement as additional income, because you have to show the income from the revenue from the main activity, and you have to show additional revenue if you have additional revenue separately. So in this example, the total revenue is 6,100, and then after you have shown the revenues, you have to show the list of expenses, because to calculate profit, revenue minus expenses. So in this example, there are 3 expenses. See here, salaries expense 1,400, rent expense 1,000, utilities expense 305, total expenses 2,705. So for this sample income statement, the profit is, or net income is 6,100 revenue minus 2,705 expenses. So the net income is $3,395. I think it is very straightforward, easy. If somebody asks you, somebody say income statement, so you can imagine, you can visualize. Income statement shows the calculation of profit and loss, profit or loss for a business. So to calculate the profit or loss, the basic idea, the basic formula is revenue minus expenses. Okay. Okay, this is statement of honest equity. Just remember, statement of honest equity is one component of the financial statement. It is a summary of changes in the honest equity that have occurred during a specific period of time. Honest equity is the amount owned by the owner of the business in the business. So this is the example for statement of honest equity. So you can see here, first item in the statement is beginning balance for the amount owned by the owner of the business. In this example, the beginning balance is 25,000. So it shows that when the business is started, the owner of the business invested 25,000 to start the business. And then for the second item is the profit made by the business. In accounting, if a business is making profit, then for a sole proprietorship business, when the business is making profit, the profit is belong to the owner of the business. Okay, so in here the profit is 3050. You can see that profit in the is coming from the income statement in the previous slide. And then less withdrawal. So if withdrawal is withdrawal is amount taken by the owner of the business. If you are an owner of a business, sometimes you take something from the business. Maybe you need cash urgently, you take cash from the business. In this example, the owner of the business take $2,000 from the business. Maybe you take items or goods from your business. Let's say you have a grocery shop. At one day you need you take 2 bags of rice. 2 bags of rice. So that is withdrawal also. I will explain more about withdrawal later. But at this point of time, you just remember withdrawal is an amount that the owner of the business take from the business. So and then see here, the beginning equity or capital plus the profit made by the business minus the withdrawal, then you will get the number for the ending capital or ending honest equity. In this example, the ending honest capital or equity is 26,050. Okay, and then the third component is balance sheet. Balance sheet is a list of all of assets, liabilities, and honest equity of a business at a specific date. So remember this. A balance sheet shows the financial condition of a business. Okay, this is the format for balance sheet. As far as I know, there are at least two formats. Another format is called statement format. But in this course, you will learn the basic format for balance sheet. It is called T format balance sheet. Okay, let's see here the T format balance sheet. You have to write the name of the business, and then balance sheet, and then the date for the balance sheet, and then you have to list all the business asset in the left side of the balance sheet, and you have to list all the liabilities and owner's equity in the right side of the balance sheet. In this sample balance sheet, the business has three assets: cash, supplies, and land. The total is 26,450. And then in the right side of the balance sheet, the business has liabilities, one liability, and then there are one item related to the equity. The item related to the equity is coming from the statement of owner's equity. Okay, so you can see here the total in the left side, 26,450, is equal to the total in the right side of the balance sheet, 2650 also. Okay, balance sheet shows the financial condition of a business. So when we say financial condition, we always refer to the amount of liability or debts compared to the total asset of a business. Okay, remember this. In accounting, if the amount of debt or liabilities is small compared to the amount of total asset, then we say that the business is in a good financial condition. See here, this is a balance sheet of a business, and then you can see assets. Assets are things owned by the business. So this business has cash, supplies, and land. Total assets for this business is 26,450. And you see the liability here. The total liability means debt, something that the business has to pay in the future. For this business, the liability is only $400. What do you think? The asset of the business is $26,450. The debt is only $400. So what do you think about the financial condition of this business? It shows that this business is in a good financial condition because the debt is very small compared to the total asset. But let's say you see a business, the total asset is 26,450. The debts, let's say the debts or liabilities is 23,000. If you see that kind of situation, then you know the business is not in a good financial condition. The asset is 26,000, the liability is 23,000. So it means every month the business has to pay or to spend a lot on paying back the debts. So that is why we say that situation is not a good financial condition. You can imagine if a business has too many debts, then very difficult that business in a difficult condition. Okay, that is balance sheet. So in this course, you have at the end of topic 5, you have to know how to prepare the income statement and balance sheet. So when you want to prepare the income statement and balance sheet, when you want to prepare the balance sheet, you also has to know how to prepare the statement of equity. So you have to know how to prepare the income statement, statement of equity, and also the balance sheet. That's all. Okay, and Okay, this is the second example for a balance sheet. I just want you to know the format. Okay, let's see. Like I said earlier, the format is like this. You have to list all the assets of a business in the left side of the balance sheet, and then in the right side of the balance sheet you have to list all the liabilities and the equity. So you can see here in this example 2, this business has 1, 2, 3, 4 assets: cash, supplies, prepaid insurance, and equipment. So total assets is 42,395, and then the business has two liabilities: account payable and unearned consulting revenue, 3,000. So total liabilities or total debts is equal to 9,200. The equity, this item is coming from the statement of equity. The equity or the amount owned by the owner of the business in this business is 33,195. So just see this format. Remember in the next chapters, I think in chapter 4, you will learn about how to prepare the income statement and statement of equity and the balance sheet. Okay. Okay, I have you have seen in the previous slide, financial statement contains 5 components: income statement, statement of equity, balance sheet, and then statement of cash flow, and then notes to the account. So now we are seeing the statement of cash flow. What is a statement of cash flow? A statement of cash flow is a summary of the cash receipts and payments for a specific period of time. So a statement of cash flow basically shows the cash in and cash out of a business. Okay, this is an example of statement of cash flow. You can see here the cash flow is categorized into 3 categories. Cash flow from operating activities, that is the first item in the statement, and then you can see here the second category of cash is cash flow from investing activities, and then the third category of cash is cash flows from financing activities. So statement of cash flow show cash in and cash out, or cash payment, cash receipt and cash payment of a business. So if you check the cash in and cash out here, okay, it contains 3 sections. Okay, and the last component in the financial statement is the notes to the account. Remember this. The notes to the account shows the detail about items shown in the income statement, in the statement of equity, and the balance sheet, and the statement of cash flow. So if you see a financial statement, in the financial statement, firstly you will see the income statement, and then statement of equity, and then balance sheet, and then statement of cash flow, and then you will see the notes to the account. The notes to the account contains the detail about everything that has been presented in the income statement, statement of equity, balance sheet, and statement of cash flow. For example, let's say in the incomes in the balance sheet, the business shows that it has motor vehicle. So the total is $150,000 motor vehicle. That is an asset, motor vehicle. In the statement notes to the account, you can see the detail of about the motor vehicle. Maybe the business has 3 motor vehicle. The first one is $60,000. The second one is $40,000. The third motor vehicle is $50,000 motor vehicle. So the total is $150,000. So that kind of thing can be seen in the notes to the account. Okay, that is the first subtopic for this part 2 topic 1 lecture. Okay, this is the second subtopic in this lecture. So elements of financial statements. Before this, you have seen components of financial statement. Now you are seeing elements of financial statements. Okay, in the financial statements, there are several elements. Okay, the first one, when you see the income statement and balance sheet and statement of equity before, in the previous slide, you can see one of the element in the financial statement is the asset. Okay, remember this. Now I will explain what is asset, what is liability, what is owner's equity, etc. Okay, the first element of financial statement is asset. Okay, asset is an accounting term. The definition of asset is resources owned and controlled by a business. Let's say there is a business. Let's say you enter a shop. That shop has many resources and items that it own and control. So resources owned and controlled by a business. So the examples of asset of a business are cash, supplies, inventory, account receivable, buildings and equipment, and also land. Sometimes a business has land. Okay, let's say you have a business. So your business will have cash, supplies, inventory, etc. So cash, everybody knows about cash. Supplies is something like this. Supplies, let's say you have a laundry business. A laundry business is a service business, and it provides laundry services. But when you provide the laundry service, you will use something like detergent, softeners, etc. Okay, you do not sell detergent and softeners, but you use detergent and softeners when you provide laundry service. Detergent and softeners, in accounting we call them supplies. Supplies are items used by a business when the business provides services. That is for a laundry shop. Example. Okay, so then inventory. Inventory is something different. Inventory is like this. Let's say you have a grocery shop. When you have a grocery shop, you sell things. You sell rice, sugar, bread, etc. So these items, you have a grocery shop. The item, the bread, sugar, rice, etc. that you keep or that you are selling in your shop are called inventories. Inventories are items that a business will sell. So a service business does not have inventory, because a service business does not sell anything. A service business provides service. A merchandising business like grocery shop and a manufacturing business like frozen food factory, for example, they have inventories because they have things that they sell. Okay, so a service business only has supplies. Okay, account receivable. Account receivable is something like this. You have a business and then you have a customer. And then one day a customer come, and then you provide service for this customer, but the customer say he will pay the amount related to the service in the future, maybe next week or maybe next month. So that amount that the customer will pay in the future, in accounting we record this amount in an account called account receivable. The account is the account records the amount that the business will receive in the future from customers. So this thing is an asset because the business will get something in the future. Okay. And then building. So if a business has a building, then the building is an asset. Also, if the business has equipments like a laundry shop has washing machine, dryer machine, so these are assets. And if a business has land, then that is also an asset. So these are the examples of asset. Assets, all these assets can be divided or categorized into two categories: short-term current asset. The first category is current asset. The second category is non-current asset. Current assets are assets that has a life of within 1 year, less than 1 year. Again, current assets are assets that has a life of less than 1 year. The easiest example is cash. If you have a business and then you have cash, you will use the cash every day. There are cash in and cash out, cash in and cash out. You will receive cash from customer, and then you will use the cash to pay salaries, to pay rental, to pay electricity, water, etc. So cash is an example of a current asset. The life of the cash very fast. It's very fast. You receive today, maybe you use this cash today also. So it will be used within 1 year. So it is a current asset. Same goes to supplies. Let's say you have a laundry shop and then you have detergents and softeners. You purchase the detergent and softeners today, and then after that maybe you will use the detergent and softeners also today and also tomorrow. So the life of the asset is less than 1 year. It will go in and it will go out. So supplies is also an example of current asset. Inventory also is a current asset. Account receivable, like I said earlier, account receivable is the amount that business will receive from customer in the future. So most of the time, if you allow customer to pay in the future, the customer will pay very quickly. Maybe within 1 month, the customer will pay. They will pay. So account receivable is an example of a current asset. Okay, the second category of asset is called non-current asset. Non-current assets are assets that have life of more than 1 year. So buildings and equipment are examples of non-current asset. If you have a business, your business has a building, then the building can be used for many years. So building is an example of a non-current asset. Equipment also can be used for many years. For example, if you have a laundry shop and then you purchase a washing machine for your laundry shop, that washing machine can be used maybe for 5 years or more. So equipment is an example of a non-current asset. Okay, the second element of financial statement is the liabilities. The simple definition for liabilities is obligations or something that a business has to pay in the future. So in other words, you can call them debts. So this is an accounting term. In the future, you are a business student. So in the future, if somebody say liability, you know, oh, liability means debt or something that the business has to pay in the future. So liabilities can be defined as obligations or things that a business has to pay in the future. Okay, the typical example for liabilities are account payable, unearned revenue, and bank loan. So account payable is something like this. Let's say you have a business. Let's say you have a laundry business, and then one day you purchase detergents from supplier. So the price of the detergents is, let's say, $800. So but you said to the supplier, you will pay the $800 next month. You take the detergents today, and then you pay next month. So that is in accounting, that is a liability because it is like a debt. You pay that in the future. So in accounting, if you do something like that, you take something from supplier but you will pay later, you have to record that in account payable. So account payable is a liability, something that the business has to pay in the future. Unearned revenue. Unearned revenue is something like this. You have a laundry shop, and then one day a customer come. He pay you $100. The customer pay you $100 today. He said he will send something next month. You have to provide laundry service for him next month. He pays today, but you have to do a service next month or perform a service next month. So when you receive the $100 today, you have to record it as unearned revenue. And unearned revenue is a liability because you take the customer cash today, but you have to do something in the future. So you cannot record it as revenue, but you have to record it as a liability, unearned revenue. Okay, the next example for liability is bank loan. You have a business, and then you want to make the business a bigger business, so you borrow money from bank. That is example of a liability. So a liability also can be categorized into two categories: current liabilities and long-term liabilities. Current liabilities are liabilities that has to be paid within 1 year. Long-term liabilities are liabilities that has to be paid in the period of more than 1 year. So if when you see these three examples that I put here, account payable and unearned revenue are examples of current asset. So most of the time, if you have account payable, you want to pay it quickly. So that's why current asset is always account payable is always a current asset. Unearned revenue also most of the time is a current liability. account payable is a current liability, unearned revenue is most of the time also current liability. But bank loan is a long-term liability. Most of the time, if you borrow money from bank, you will have to pay back in 5 years, maybe 10 years. So most of the time, a bank loan is a long-term liability. When you prepare a balance sheet, you have to categorize the assets and liabilities into current assets, current liabilities, and non-current asset and long-term liabilities. So the categories you have to understand the categories that I have just explained. Okay, and then the last thing, the third element that you can see in a financial statement is owner's equity. Owner's equity is amount owned by the owner of the business in the business. So let's say you have a laundry shop. Owner's equity means the amount owned by you in the business. The business is big business. The business is a small laundry shop business. The owner's equity means the amount owned by you in the business. So owner's equity are related to 4 accounts. Okay, I will tell you. Owner's equity are related to 4 accounts. The first one is capital. Capital is the amount invested by the owner of the business in the business. So for let's say you have a laundry shop. Capital is something like this. When you start the laundry shop, you invested $30,000. You take $30,000 from your bank account. You start the business. That $30,000 is the capital. In accounting, we call this $30,000 as capital. Capital is amount owned by you. Okay, that is easy, straightforward. Okay, the second thing related to owner's equity is retained earnings. Retained earnings is something like this. Retained earnings are profit made by the business in the previous year. So the thing is like this. You have started the laundry shop. After 1 year, the laundry shop makes $10,000 profit. That $10,000 profit is retained earning. When the business makes profit, the profit belongs to the owner of the business, belongs to you. You have a laundry shop, you invested $30,000. After 1 year, the laundry shop make $10,000 profit. Okay, let's say $10,000 profit. That $10,000 profit is owner's equity, belong to you because that business is your business, a sole proprietorship business. So all the profit belongs to the owner of the business. Okay, another things is related to the profit. When you want to calculate the profit, like I said earlier, the basic formula to calculate profit in accounting is revenue minus expenses. So retained earnings is related to revenue and expenses. What is revenue? Revenue is increase in a company's or increase in a business resources from the sale of goods or services. So if you have a laundry shop, revenue means the amount that you get from providing laundry service to your customer. You provide laundry service to a customer, he pays you $50. That is revenue for your laundry business. Expenses, the simple definition is amounts incurred in the normal cost of the business to generate revenues. Okay, you have seen the example of expenses in the previous slide. If you have a business, you have to pay rental, you have to pay salary. Okay, rental is an expense. Salary, worker salary also is an expense. You have to pay electricity, water, internet bill. So this electricity, water, internet, etc. in accounting, we record them in one account. We call it utility account. So utilities expense, utilities also is an expense. So utilities expense. Another account or item related to honest equity is withdrawal. If you have a business, you are an owner of a business, sometimes you take something from the business. And let's say you have a laundry shop, and one day you need cash urgently, so you take $200 from the business. So in accounting we call it withdrawal. Withdrawal maybe is in the form of cash. You take cash from your business, or withdrawal also can be in the form of you take other type of assets from the business. For example, you have a laundry shop, and then one day you take detergent. The value of the detergent is $30 from your business. You take the detergent and you use the detergent at home. So that $30 is also a withdrawal. The owner of the business takes something from the business. It is a withdrawal. So withdrawal will reduce the honest equity, isn't it? When you put capital into the business, the equity increase. When the business is making profit, the equity also will increase. But when you do withdrawal, the equity or the amount owned by the owner of the business in the business will decrease, because you take something from the business. You, the owner, take something. And also, when let's say if a business make loss, then that also will reduce the honest equity. Loss is the opposite of profit. If your business makes profit, the honest equity will increase because the profit belongs to the owner. But if a business makes loss, and then so the honest equity will decrease. You will see that more in the next chapters, in the next topic. Thank you very much. This is the end of the first lecture this week. Do not forget to write your name and metric number in the comment section. I will take them as the lecture attendance. Thank you very much.